Good morning. And today we're going to be talking a little bit about whether we're bullish China, which is a bit of a weird one. And then we're going to move on to the most important moving average in markets right now, this second. And then today's trading takeout is going to focus on how to actually enter a trade effectively and from a psychological perspective to make it easier on yourself. So in front of me, I've got Chinese inflation on a year-on-year basis. Now, this does include energy and food, so it's the more volatile component. But what's key here is that for a couple of months there, China was actually in a deflationary period. Now, this is important because obviously China exports to the rest of the world. So if things are cheap in China, then things are going to get cheaper elsewhere. And this could be a key driver of, the reasons as to why certain goods and certain prices have been decreasing across the globe. Now, the problem here, however, is that on the most recent reading, which was just in the last couple of days, we've actually ticked back up into positive territory on the inflation count. Now, whether this will last or not is a different story. So I'm going to show you as well, if I can find it. I can't find it right now, but Chinese factory prices had an absolute nosedive. And this is basically the equivalent of the producer price index. Now, the producer price index tends to lead the CPI. And the producer price index, as I said, had collapsed in China pretty harshly. Now, it's collapsing elsewhere as well. It's collapsed in Germany, the UK, and the US. So there is a lead time on this of about 3 to 6 months, which is important, which, begs the question as to whether this will be sustained or not. Now, we're still getting time lags from the pandemic, of course, and also from the Ukraine war. So we are still seeing, base effects sort of come into play, but there's still a massive bit of room for prices to head lower. Now, the reason why I say we bullish China here is because positive CPI is an indicator of a strong consumer base. Are people buying? And I think we're aware of the issues that has been going on in China. If you're not, they're effectively having their 2007, 2008 in the property market, where too much wealth has been accumulated via debt in property, in hard assets, if you like. And now they're sort of seeing the undoing of that as demand falters and things sort of recalibrate. So the question that we have to ask ourselves as traders to be able to develop a picture of what's going on is, do we think the probability of inflation now heading to the upside in China is greater or less than the probability of it heading lower? In my view, I believe that we still are in disinflationary, at least, pressures. So China is still facing disinflation. Their property sector, where all the wealth is tied up, is still not rectified. That's going to be a really long story that still goes on for many years now. And also they're struggling from a consumer side to get people to actually buy. They've been trying to become a consumer-led economy rather than an export-led economy, and it's just not really doing that well. And you can probably see this as well if we look at the dollar CNY. So if we look at, dollar CNH, my apologies. So if we look at that, we can see that the dollar is strengthened versus the yuan for the most in 10 months. And I believe on the onshore yuan, it hit a 16-year high. So it hit the highs of 2007, 2008 as well, which showed, and I think I might have it here actually. Let's have a look. Which showed, yes, here you go. So the onshore yuan hit a 16-year high, which shows that, there's considerable stimulus from devaluing the yuan, etc., that can be sought. And I think this is what the PBOC might have been doing. They might have been buying dollars to actually weaken the yuan or selling the yuan on the open market, perhaps. And this has created this potential stimulus effect, which is why we're actually seeing the CPI tick up. If you weaken a currency, it's likely to induce some form of inflation. So that's my position in here. on the dollar yuan. And really, from a trading perspective, you want to be thinking of, okay, how could this influence global monetary policy? You know, are these conditions coming out of China where Chinese goods are getting more expensive again? Are they going to spread over to the US, the UK, et cetera, et cetera? You know, how might it cause a tick up in inflation? And therefore, how might it change the thoughts of each respective central bank? Now, on to the euro, the most traded currency pair in the world, the most liquid, probably, asset in the world, actually. And it's at a very, very interesting juncture. I really, really like the euro here. In a negative perspective, I like selling it, which isn't advice, but I think from what I'm going to explain here, you can make your own mind up as to what the probability is, the likelihood is of the euro going in one direction over the other. So this is going to be mainly from a technical perspective initially, and then I'm going to bring in more of the fundamentals after. But this is the most important moving average in markets at the moment, in my opinion. You've got the 200 weekly moving average here, right into a 15 years of trend channel, if you like. I hate trend lines because people think trend lines should absolutely respect, the line to the point or to the tick, and it just doesn't work like that. And so you've got a really long-term moving average there, really long-term technical price indicator, I guess. And then you've got a really long-term channel there as well. So whenever you have longer-term technicals, it means that the outcome is going to be more important because you're looking at data that has a greater frequency in effect. If you were to nail down into not on a monthly time frame, onto like a 5-minute time frame, for example, and look at here, look at here, look at here, look at here, and look at here, you'd be able to see all of the interest and the way the market's moving there, and you'd be able to see how sellers just keep overwhelming, which leads you to believe that, okay, in the right context of fundamentals, which I'm going to get onto, there's a probabilistic opportunity here. That's all we're looking at here. We're looking at probability. That's all. And so what you can see more recently in the last 3 months is that we've had a spike into the channel. At the same time, we've had a spike into the 200 weekly moving average. And then we've just traded off. Okay. And from the way that the candles or bars behave here, that spike above and close below this high here, basically the previous April high, is quite key, purely because you can really see that sellers just overwhelmed. They didn't want to use this bit as support to then go higher, so they didn't want to see this. So there, what they saw was, oh no, okay. So fantastic bit of, and I hate this term, confluence there, because you then have to start thinking of which participants are also looking at that. CTAs, so commodity trading advisors, they tend to look at longer term moving averages because they love trends. They trade trends and they exit when the trend breaks. So what this probably is indicating is that, okay, we've seen that the longer term moving average has been hit. The fundamentals are in our favor. Again, I'm going to get onto those in a second. And so we can trade now with this new trend. It makes sense to do that. Whereas perhaps, I don't know, here it didn't. It made no sense to do that. And so we're now looking at the situation where, okay, how can we measure where the market's likely to go? Likely, not where it is going to go, likely. That's all we're doing, is we are taking a probabilistic bet on everything that we're doing. And there's the obvious, places that people tend to look for, which is lows. This would be, I would hate to see what the situation is if we were to get back down here, but, we'll see. What I think this would require, and this is when you start introducing if and then scenarios into how to think about exiting. If this were to occur, then we'd probably be looking at, again, like in China, the requirement for the euro to be much, much weaker, okay, to stimulate the economy. So that's really where we're looking. And I think if we were to get down here, the the context of risk would be quite bad. So I would expect equities also to have sold off if we were to get down here. Stronger dollar, not good for risk. So we trade lower. But if you think about it, all of that view is really stemming from up here. Look previous, we traded here before it sold off. We have visited even up here before it sold off. Up here, sold off. Here, sold off. So we've traded through there, and the fundamentals currently are weak Eurozone. We are in a very, very weak Eurozone. The dollar smile, which is effectively 3 or 4 quadrants of how the dollar behaves during different periods. So if the US is outperforming in terms of growth, in terms of economic fundamentals like it is now, then while the rest of the world is slightly weaker, then the dollar tends to increase because treasury yield will be higher. People can earn more in the US by parking their dollars there. The dollar starts selling off when everyone else is catching up and growth is good. Okay. And the dollar also sells off when there is expected stimulus globally to occur. So when something called swap lines open up between different central banks to try and liquefy things. But generally, if you look over time, being long the dollar is it is an edge at the end of the day. It really, really is an edge, purely because, I guess, if you think about the composition of the dollar, they effectively own the world via the credit channels and via being, the largest GDP nation in the world, which ties into the fact that the dollar is the reserve currency. So this is always what we're looking at. We're always trying to make probabilistic bets, and the probability of the entry here, not the exit, stems all the way from this moving average here that I've messily drawn. So I hope that was useful. Now on to today's trading takeout, which is effectively how to enter the market well. Now, a lot of people tend to, when they're getting into a trade, just go, full size right away. They choose their size, choose the stop loss amount, etc., and then just click buy or sell, and then that's it. Now, a more effective way might be to think of it as, okay, how do I make this a little bit more relaxing for myself? Because let's face it, executing a trade is still quite panicky. I get panicked even after 12 years of doing it. So what I do to stop that, to stop myself from, basically worrying, is I think of the amount that I want to get into the trade by eventually. And then I think to myself, okay, what amount can I get in now which will make me feel absolutely nothing? So then it's usually about a quarter of the amount that I initially think of. And then when I see that tick into profit, when I see it get a little bit greener, I'm able to then say, okay, now I can size up a little bit more. So I'll enter another quarter of the original position size. And then eventually what I'm able to do is have almost 4 different trades on, and I can think of them independently. So I can think of, my overall position size as being 4 completely different trades, which then allows me to risk manage each component of that position very, very differently. I tend to use volatility stops. I don't use hard stop losses based on price or market structure. I like to make my risk more objective. And this is a really, really good way to do that when you're splitting up your orders. So have a play with it, see what you think, and do comment, ask some questions on this video, but most importantly, do like it. Good luck today.